Hi, and welcome to Futures Discovery on John Lothian News. I'm your host, Cortez Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're diving into the intricate world of equity index futures, a topic that can shape the flow of your futures trading journey. Equity index futures are financial contracts that allow traders to speculate on the future value of an underlying equity index, such as the S&P 500, NASDAQ 100, or Dow Jones Industrial Average. These futures contracts derive their value from the performance of the index they represent and are widely used by investors and traders for various purposes, including hedging against market risk, portfolio diversification, and speculation on market movements. In the realm of quantitative trading, where algorithms reign supreme, the stakes are high and the challenges are abundant. But what sets apart the quantitative trader in this arena? Well, it's a combination of mathematical prowess and a keen understanding of market dynamics. You see, quantitative traders must employ sophisticated models built on layers of mathematical algorithms and statistical analysis to make trading decisions. However, these models can be a double-edged sword. One of the biggest pitfalls for quantitative traders is overfitting. This is when a model is so finely tuned to historical data that it fails to perform effectively in real-time trading scenarios, as the story of yesterday isn't always the best predictor of tomorrow. Now, let's talk data. Data is the lifeblood of financial models. It's not just about having access to vast amounts of data, but also ensuring its quality, granularity, and accuracy. After all, garbage in, garbage out. And then there's the speed factor. In today's high-frequency trading environment, every millisecond counts. Quantitative traders must strike a delicate balance between processing massive data sets and executing trades with lightning speed. But it's not just about numbers and algorithms. Professionals must also navigate the ever-changing macroeconomic landscape, the nuances of rolling contracts, and the complexity of market liquidity. And let's not forget about leverage. While it can amplify gains, it can also amplify losses. It's important to keep a constant eye on risk parameters and how volatile your overall portfolio is. Now, add to this mix the shadow of regulatory shifts, market structure changes, geopolitical events, and technological pitfalls, and you have a recipe for volatility. Volatility refers to the degree of variation or fluctuation in the prices of futures contracts for stock market indexes. It indicates the level of uncertainty or risk associated with contracts, and it reflects how much the prices of these contracts are expected to change over a certain period of time. So how does one navigate this maze? Well, it takes more than just quantitative prowess. It takes a deep understanding of the market's broader tapestry. It's about staying agile, adapting to change, and constantly refining your strategies. And there you have it, a quick overview of equity index futures and how quantitative traders navigate in this space. Now remember, this is just scratching the surface. To gain deeper insights, let's talk to Megan Morgan, current head of market structure at Belvedere Trading, who brings a wealth of experience in the futures industry. Megan's wealth of experience and deep insights makes her an ideal guest to navigate the complexities of this market. Megan, thank you for joining us today.
Thanks, Cortez. It's great to be here.
Can you elaborate on the significance of equity index futures in today's financial landscape?
I definitely built a career around many different markets, and each one having their various set of benchmarks, and equity indexes are definitely one of those that comprise markets all across the globe. At the broadest scope, it represents, a very liquid, highly used equity index, represents the health of an economy, right? Or a segment of an economy. So if you think about it, the first thing you hear when you turn on the news is, what did the S&P do today? What did the Nikkei do today? What did the Eurostoxx 50? FTSE, and that really shows what is going on. If a war broke out, they talk about the equity, the corresponding equity index and where that is. So it really is the basis of how we think in terms of economies and geopolitical activities across the globe. It's a benchmark for performance. So as investors go to put their money with asset managers, they are going to use these equity indices as a benchmark for performance. And then the second thing is it is used as an investment tool, right? So for passive investors, they know they can safely put their money into various structured products or investment tools that are built around these equity indices and invest over the long haul and not have to think about their money, and their money's generally going to give good returns.
Even if you're not in the financial space, you hear about the S&P, you hear about these large indices so many times, right? And just to think about it kind of conceptually as to health. And that's why people are always talking and thinking about and expressing their feelings towards the market and these indices because they represent the health of the economy. Can you go into detail about building new indices and markets, highlighting some of the nuances and challenges involved in this process?
To really have an equity index, a successful equity index, it's got to be a widely accepted proxy for a certain segment of the market, right? And that sounds a lot easier said than done, right? So, by proxy, it means it needs to be relevant, it needs to be significant, and then widely accepted. Everybody has to agree that this index represents what they're trying to achieve, right? And that means I need to think it's relevant, and you need to think it's relevant. S&P 500, does that represent the US economy, right? Like, do the components that are mostly outsourcing to China or, global firms that have big presences, is that truly the benchmark for the US? So, and you can poke holes in a lot of these indices that are considered the benchmark already, let alone when you try and build one. I think what's really interesting now, in the past 10 years, and I experienced this, working in the European markets, is ESG is a great example, right? So building indices that have like this ESG theme that are relevant in the ESG, lens. I mean, is it E? Is it S? Is it G? How do we agree on what those are? How do we agree on how to measure the companies? So this is one thing that, especially in Europe, everyone has their own definition of what is ESG, right? Like France thinks it's nuclear power. Germany has like no nuclear, right? So how do you accept how do you create a benchmark that's big enough to be relevant, but also customized enough to be accepted by the people using it? When it is tradable, investable, has and then has liquidity, and we can talk about this later as we go on. This is a component of market structure, then that creates more users, more investors, et cetera. But again, if you create it too niche-y, then you're only going to have a small component of people that want to use that as an investment tool. It's quite a delicate balance.
Using your dynamic background in market structure, how do you approach equity index futures?
Yeah, I mean, I think that's the second part of a successful equity index, right? Is creating something that can be tradable, investable, highly used, and in creating a foundation of innovation for all investor types to really get into, from institutional investing, pension funds, insurance, down to my 401k, right? And so that's where market structure comes into play, because if an index is created and then lists futures and options in a market structure that has barriers to entry, high barriers to entry, or restrictions on being how to invest or being able to invest in that, then that benchmark is not accessible.
We talked a little bit about, the success, what makes markets successful, and then also, why do the ones that fail?
Markets don't grow in straight lines. Markets grow in hockey sticks. 2 traders, 8 traders, 16 traders, 1,000, right? And it's really about how you get to this inflection point. And once a market is gets to an inflection point, then the liquidity just drives itself to success. What we have seen in building successful markets is there has to be a first natural mover, someone who wants to use this product, this market, this benchmark, this index, and has a need for it so much in their portfolio, or the risk that they're trying to mitigate, that will outweigh the cost of an illiquid market. I think the best success story that I've seen so far in my career is VIX. VIX came out of nowhere and really hit that inflection point right after the financial crisis in 2008. And they had a natural, it was a great story to tell, right? Like in the financial crisis, it didn't matter how diversified and how uncorrelated your portfolio was. Correlations went to 1 and the market went to 0. And the only asset that went up was volatility. And so, all of a sudden you had this asset that you had this great story to tell. Lehman Brothers, which quickly turned to Barclays, had a volatility ETF, so retail could get into it. The VXX assets started pouring in. They hedged in the futures market. The futures started taking off. And all of a sudden, the options started taking off, and everybody was adding VIX to their portfolio and just finding ways to get into it. And then, at the same time, CNBC is labeling it the fear gauge, right? Bells and whistles galore. Everybody was using it, and it became a proxy again for how the health of the market that we look to today.
First, let's talk about that. Markets don't just go on a straight line. I really like that. They move in hockey sticks. I think that's so true. And we see that all around the space. VIX, Bitcoin, anything that you really look at here, it's really just through the roof. It starts off slow, and then the things that stay and catch on take this hockey stick movement. And I really enjoyed that piece of it. And the part that you added to being usable, right? The VIX became another understanding for the health of the economy, or health of where's the gauge at? How are people feeling? How is the market feeling? And so having a usable, intuitive use for why this thing is here, why do we have it on our portfolio, is such an important, I think, factor for making markets successful and building something that's successful. How do you see the role of quantitative trading evolving in the context of equity index futures, considering advancements in technology, data, and increasingly complex market dynamics?
The world of trading is not just traders, right? In order to create a successful trading strategy, you need traders. They're very, very important. They are the first thing you need, right? But quickly thereafter, quants, technologists, people understand market structure. I don't know if I'm fourth, but I'm there, the list of people, I'm definitely going to fit in there, right? But there are so many facets of the people that are important to putting together a successful trading strategy. And that is evolving, right? So that list of people looked very different when I started trading, right? It was smaller and much more generalized. And now it's getting, you could definitely have, and you have a market data team. Exactly what I'm saying. You could have someone just sitting there analyzing qualitative market data. And how does that affect again, I go back to, does the number of train cars sitting at some hub in Texas have a correlation to the S&P 500? Could,
Yeah.
And that's what I think is just interesting, as it's evolving constantly. And my son is in middle school, and I went to his curriculum night this year, and this slide that his science teacher put up blew my mind. And this is very relevant. I'm going to bring it home here in a sec.
Thank you.
He said, like it was a US Department of Labor's department statistic. And it was something along the lines of like 70% of middle schoolers are going to be in jobs that aren't invented yet. And so, I mean, that to me is mind blowing. We have no idea where we're going to be 10 years from now. And that's what's so exciting about, that's what's so exciting is like about our industry is like, you don't have to be like, I want to be a trader to find this industry interesting, right? Like, there's so many other facets that are wildly interesting and very important to making these markets successful and, stable and open every day and, continuing to function and grow. Anyone can really find a place in the trading industry and quantitative trading and options trading, whatever, wherever the opportunity lands.
What is some other advice that you would offer, aspiring individuals like myself looking to enter the world of equity index futures or just the financial space in general, considering, the multifaceted challenges and opportunities in the space? What is some advice you can offer to us?
The best advice I would say is to start your career off at a firm where you can touch many different parts of the business, right? So I've always thought to start at like the biggest firm you can start out with in your career is the best place to start because you're going to see so many different avenues of the business and you're going to be exposed to it, right? And from there, you kind of can create this foundation of where you go next. But, when I started out, I just had this idea of where I'm going to go, I'm going to be for the next 20 years, which is just so now that I look back, it's like, that's not the right attitude. Like where you're going to go is like what you're going to learn the most. There's this book, everything I learned in life, I learned in kindergarten because that's the first year you're in school. That is so true of like my career. A lot of what I take now was within those first few years on the floor. I mean, that set such a massive foundation of my career in life lessons, in learning how I think, now I think in terms of options. So, being able to get exposed to being able to be in a company where you are going to be exposed to so many different areas of the business is really going to set a foundation for you as your career continues to get more niche-y as it goes along.
And so, on that note, Megan, we appreciate your time and insights into equity index futures. Your wealth of experience and expertise has provided a unique and enriching perspective, contributing significantly to our exploration of the dynamic world of financial futures. Thank you for being a part of Futures Discovery.
Thanks, Cortez. It's been a pleasure.
If you're enjoying the content today on Futures Discovery and want to learn more about derivative markets, look at some other videos on our series, but also check out Options Discovery hosted by Esma to learn more about the space.